This following slide is a great summary of the main differences between the equity and debt. We just spoke about them, but here is a little bit more detailed presentation of the main finance and legal differences. Let's analyze them. In case of the equity, no interest payment. In case of the debt, yes, there are interest payments, whether coupons or interest on the bank loans. In case of the equity, no mandatory fixed payments, so dividends are discretionary. It's an option. You are not obliged to pay to the owners, even if they do a lot of pressure to CEO, CFO to be paid regularly. In case of the debt has a fixed repayment schedule. Once you define it, once you sign the bank facility agreement, you have to repay it on predefined dates. In case of the equity, no maturity dates, no capital repayment, it goes forever. In case of the debt has the first claim on the firm's assets in the events of liquidation. So they are seniors, they are firstly repaid. In case of the equity, there is ownership, we spoke about that, and there is a control over the business. In case of the debt requires covenants and financial performance metrics that you must satisfy. Such performances or metrics indicators must be met. In case of the equity, typically there are voting rights. In case of debt, you have many restrictions, covenants on operational flexibility that you have to fulfill and respect when you are doing your business. In case of the equity, the owners, it implies the cost of capital, the dividends, okay, high one, it is at least higher than in case of the debt. In case of the debt is supposed to have a lower cost of financing than equity, than shareholders. We say that the owners, shareholders are juniors to the lenders, they are subordinated to the lenders, they are paid at the end once the lenders, bondholders, bank lenders are paid, state employees, they are at the end to be repaid, so they are juniors. Lenders are seniors, they are firstly to be paid in case of liquidation, in case of the problems. They are seniors to the juniors, to the shareholders, to the equity. A few other differences. In case of the equity, the owners, they have last claim on the firm's assets in the event of the liquidation. We just explained that they are at the end to be repaid if there are some outstanding assets or cash. And in case of the equity, it provides maximum operational flexibility. You have much more flexibility than in case of lenders, where you have a lot of restrictive or standard covenants, restrictions to do the business. You cannot do whatever you want. They keep eye on you, they want that you are as safe as much as possible, because they want to be sure that you will repay on regular days their annuities, their principal and interests.